In this webcast, I will be going over some of the property issues in China and really looking into some of the claims that are being made. A lot of talk about China's financial system potentially collapsing, which I think is very extreme talk. I'll be going through some of the headline figures in terms of property debt, who is lending to property developers and where some of the risks lie. And then I will be going over, despite the negative news in the press on China, that actually there's a lot of bright spots in its economy, and from an investment perspective, why I think China is very attractive today. So just quickly going over the summary of our argument. You'll see a lot of talk about China in the press, but I think you really have to look into the numbers to understand what is going on. A lot of the commentary doesn't really put any numbers at all, and they talk about the collapse of the financial system or particular stresses. But if you actually delve deeper into the figures, you understand where the risks lie. So the numbers I'll refer to in this presentation will be in renminbi/yuan. If you want to convert to US dollars, just divide the numbers by an exchange rate of 7. We estimate that the commercial property debt in China is around 19 trillion yuan. That is worth about 16% of China GDP. But it's important to look at the composition of that debt. 79% of the debt towards developers is lent from the banks. The trusts, otherwise known as wealth management products / shadow banking, is only 1.3 trillion or 7% of the debt that developers have. And I think that's really important, because if there are going to be stresses on China's financial system, it is going to have to be on the banks. And while you will see a few credit funds essentially going bankrupt, like we saw the other week with Zhongzhong Trust, actually their impact on the wider system is fairly limited. As we will show later on, the banking system does have enough risk buffers to absorb losses, but we may see a few smaller banks needing equity injections. Potentially they will need to be acquired by the larger banks, but we think the system is robust enough to absorb that. And more trust products may fail, but we think the sector may need capital injection, but the impact on the wider financial system is relatively limited. On the bond side, yes, you'll see stories of Country Garden right now having issues paying back their bonds, but actually the financing from bonds is a relatively smaller portion of the overall debt pile. So offshore bonds, so US dollar denominated bonds, only worth 1.3 trillion, which is equivalent to 1.1% of GDP. Domestic bonds a little bit larger. Now, you might think when you read the press that all property developers in China are really struggling, but I think it's important to make the split between state-owned enterprises and the private companies. If you look at the onshore bond market, the state-owned enterprises account for 61% of the bonds outstanding. Less than 1% of these state-owned enterprises have defaulted on their debt. Where the stresses lie are with the private developers. Their debt or their bonds account for 39% of the onshore bond market, and there about half of those developers are struggling to pay back their bonds. So I think that's quite an important distinction to make. So while the bond financing element for the developers is actually quite a small portion of the overall pile, most of the stresses are actually in the private sector, not with the state-owned enterprises. So the sense that everyone is really struggling with the balance sheet in China is actually not accurate. And in terms of how to go through some of these, how to fix some of these solutions, the government really has to stimulate the demand, but not by enough to start another property bubble. They need to ensure that the projects by Evergrande, Country Garden, and so on are completed. But then there's a question of how to handle the inventory sitting on these companies' balance sheets. So there's unlikely to be one big solution to solve this inventory problem. We think state-owned developers, asset management companies are part of the solution, but they're not big enough to be the whole solution. We think the local governments are facing too much funding pressure to take on some of this inventory themselves. So that was just a very quick summary of our argument, and now I will go into the details. So I think it's important in China to remember that the weakness is government induced. For about a decade, a lot of people have been warning about the rising level of debt within the Chinese economy, and a lot of that debt has built up within the property sector. So the government does know this, and back in 2020, which at the time China's economy was doing relatively better when they had good control over COVID, they decided to introduce the 3 red lines policy. The aim of this policy was to deleverage the property sector, because the likes of Evergrande, Country Garden, and so on were using a lot of debt, a lot of pre-sale funds to just continue growing. And the 3 red lines policy essentially capped the amount of debt that property developers could hold. This model essentially finished Evergrande's business model and has led to weaknesses for the private property developers. So the current weakness in the property market is actually government induced. They did want to deleverage the sector, and we can see that in the chart on the right, which is showing the total amount of property debt, which you can see peaked at 21 trillion in 2020 and is now at about 19 trillion. The government does want to reduce the amount of debt within the property sector, because if you think about it from the government's perspective, what is going to make China rich? Currently, property accounts for about 20% of GDP if you add in the indirect sectors, and China's GDP per capita is about $12,000 per person. What is going to take China from the GDP per capita of $12,000 today to say $30,000 in the coming years? It is not really going to be property. It's not going to be video games or e-commerce. It is going to be the move up the value chain. It is going to be electric vehicles, renewable energy related industries. Those are the sorts of areas that are going to underpin China's growth in the medium to long term. And it is going to be a transition period as China reduces its reliance on property to generate economic growth. Now, as a result of the 3 red lines policy, you saw private property developers no longer able to aggressively grow using debt and pre-sale proceeds. We then saw last year that certain property projects were not going ahead, and then we've seen weakness across the sector. So here showing the price changes for the 70 large cities, and everyone knows the story that the prices overall have been declining. And this is important in China, given the large reliance on property, on wealth. So in China, property accounts for about 60% of household wealth, which is a lot higher than other major markets. I do think it's one of the government's aims to reduce this reliance on property as a source of wealth, which, by the way, is quite bullish for stocks. The government does eventually want more wealth tied up in the stock market, and I think that's quite beneficial from an A-share demand perspective. Here, just showing the price changes, but on a more segmented basis. So on the left-hand side, breaking down prices by the tier of city. So your tier 1 cities are the richest cities, Beijing, Shanghai, and so on. Tier 3 cities will be the smaller cities. Now, I'm showing quite a long time scale, starting from 2005, to show that there have been various property cycles in China, and we have been here before, which is quite an important point. The current price weakness is not a completely new phenomenon to China. On the right-hand side, I'm showing the data using a shorter time frame, so starting from 2019, and you can see that actually the price changes are quite different depending on the city you're in. So in the tier 3 cities, prices actually were quite negative for much of 2022. You can see there has been a bit of a rebound over the past few months. And it's really in those tier 3 cities where the problems mostly lie. That is where the likes of Evergrande simply built too much property and where you've got excess inventory sitting on the balance sheets. That was the price changes, but of course, the other side of the equation is the volume. And you can see here, volumes of property being sold down about 30% on a year-on-year basis. So while the prices have been falling, the absolute numbers are, in the grand scheme of things, pretty low, whereas the volume changes have been actually quite significant in China. As a result of these declining volumes, we've seen the short-term liquidity numbers for the private property developers worsen. So back in 2020, if we're looking at the cash to short-term debt ratio, 18 out of the 20 private developers here had a ratio of above 1, i.e. they had enough cash on the balance sheet to pay back their short-term debt. As a result of the 3 red lines policy and the resulting weakness in the property market, at the end of 2022, only 3 of the property developers had enough cash to pay back their short-term debt, and that number has fallen since. So a large portion of the problems in China are actually related to these private property developers. As mentioned, the inventories are increasing. Here showing the inventory by the tier of city, and you can see the problem area mostly is the tier 3 cities in blue, where the inventory is now 25 months, which is the highest since at least 2014. You can see that the inventory for the tier 1 cities in green is also above its historical average, but the demand for properties highest in those cities, and that isn't really the biggest problem area. They're considered more high quality assets in those cities. The problem area is really your tier 3 cities in blue. In terms of how the property developers are doing right now, again, I think it's important to make the distinction between the state-owned property developers and the private property developers. This chart is showing the pre-sales for the developers as a percentage of their level in June 2021. June 2021, property was still doing relatively okay. You can see that for the private property developers in light blue and gray, their pre-sales are now only 10 to 20% of what they were compared to their peak. Their whole business model has completely shifted because they're not allowed to use debt to fund their growth, and they are the ones that are really struggling. Hence, they're finding it difficult to pay back their debt. The state-owned enterprises on a relative basis are doing better, so their pre-sales at about half of their level compared to the peak, so doing better than the private property developers, but also not doing that great in the grand scheme of things. Pre-sales down 50% is still not amazing on an absolute level. And now looking into the issue of debt. Here there will be our estimates of some of the main numbers in China. The first question is, how much property debt is there in the country? We estimate the total is 58 trillion renminbi, of which 39 trillion is in mortgage debt and 19 trillion is property developer debt. We're not concerned by the mortgage debt in China. The reasons for that is because there are no real signs of stress for that portion of the debt. Also worth bearing in mind that the mortgages are full recourse. So if they are stressed, the banks can go and claim the assets of the underlying debtor. In China, no mortgages are allowed after a person has bought their second property. And normally there's very high down payment ratios, although they were recently lowered. But we're not ultimately seeing signs of stress in the mortgage debt market. The signs of stress are in the commercial property sector. So that is the 19 trillion yuan. And then if we look deeper into the composition of this 19 trillion, it's important to note the split there. So 15 trillion is lent from the banks. And that is very important because if there are going to be stresses on the financial system in China, it is going to have to come through the banking portion of the loans. The trusts / wealth management products / shadow banking only account for 7% of the total. So while you will see probably a few more wealth management product failing, the impact on the wider question really needs to be put into context. The remaining portion of the debt, so 14% of the total, is in the form of bonds. And then now we look into potential losses for the bank portion. So that is the 15 trillion of bank debt. So here is a sensitivity analysis. On the left-hand side, you see on this 15 trillion of debt, what is your estimate of the probability of default? On the top of the table, you say, okay, what is the loss given default? So the way to interpret it is, for example, if you think there is a 10% probability of default on all of the bank debt, and then if there is a default, how much is ultimately lost? Say 40%, you reach a loss of 0.6 trillion. If you are more aggressive and you think, okay, I think there's a 40% probability of default, and if there is a default, ultimately going to lose 60% of the assets, then you see it's a 3.6 trillion loss. The reason I've shown this as a sensitivity analysis is because no one ultimately knows what these numbers are. I think it's a good idea to test a wide range of assumptions. So that's one part of the equation. What is the potential loss on the bank debt? And then your next question has to be, how much capital is there to absorb these losses? And I think that part of the equation is missing from a lot of the commentary in the press. If you look at the banking system, there is, call it 33 trillion of capital ready to absorb some of these losses. And you can see the split by the type of bank. And the broad point is the banking system has a lot of equity and a lot of risk buffers to absorb some of these losses. And that's a very important point, that yes, while there will likely be losses as a result of the macroprudential policies of the People's Bank of China, the capital is there to absorb these losses. Here is China's capital adequacy ratio since 2009. And you can see the general trend has been increasing over that period. So the People's Bank of China has really been following the Basel III Accords and forcing the banks to hold more capital based on their risk-weighted assets. And they've been doing that precisely for this reason, so that when there is the downturn in the property market, that the banks have the risk buffers available to absorb these losses. So while the losses will probably occur in some of these bank loans, the system can absorb it. So on a more comprehensive basis, showing the same table on the top, the losses on the bank debt, you then see, okay, based on those same sorts of probability of defaults and the losses given defaults, what sort of NPL ratios are we looking at? So NPL is non-performing loan ratio. Again, quite hard to pinpoint the right number, but the whole point is you can do your sensitivity analysis depending on how aggressive or conservative you want to be. So you can see in this set of assumptions, if you're going for a really aggressive scenario, and you assume a 50% probability of default and an 80% loss given default, you get an NPL ratio of 40% on this bank debt. And then you say, okay, what is that number as a percentage of the total capital base for the banking sector? And even in this aggressive scenario, it's 18%, i.e. 18% of the capital of the banking sector would be wiped out in this very aggressive scenario, which I think is manageable for this portion of the property debt. And that is no accident. As I've said, it is because China has built up the capital adequacy ratio over the past decade exactly for this reason. And that's why, again, I repeat, it's important to run through the numbers, because yes, there will be losses on some of the property debt. But I think what most people miss is doing this sort of analysis, and actually the sector can take the losses. Some may be interested in the wider impact of rising NPLs. So here we show what some of the work that Goldman Sachs have done, where they look at the wider impact on the banking system. So they look at a 7% NPL ratio on all of the loans in the banking system and see what happens there. And they then compare the expected losses against the risk buffers. So that is defined as the capital in excess of the minimum core equity tier 1. And the conclusion is, which we broadly agree with, is that the large banks do have enough risk buffers to absorb potential losses. But if you see for the small banks, the potential losses are greater than the available risk buffers. So it is possible, and I think there's a decent chance of this happening, of a few of these small banks potentially needing a bailout. These will likely be the banks which are too aggressive, so have lent too much towards the property sector, where their underlying developers who have borrowed funds are unable to pay back the debt. We can see a situation where some of these small banks will need capital injections. I do think the likeliest scenario in those cases is where the large banks take over those small banks. And the reason for that is because the large banks have that risk buffer. So to repeat, the system as a whole has enough risk buffers to absorb expected losses, but we may see a few small banks failing and the large banks taking them over. Moving on to the trusts, who account for about 7% of the debt for the property developers. A few weeks ago, you may have seen Zhongzheng Trust, which has not paid back all of its customers, notes that this particular company has higher exposure to the real estate sector. So their exposure to real estate, 11% of their total assets under management, a lot higher than the average wealth management product with 7% exposure to real estate. Worth bearing in mind that Zhongzheng's real estate assets were only 67 billion yuan, equivalent to 0.3% of the total industry's assets. So that does need to be put into context if we are being fair and reasonable. According to the China Trustee Association, there's 21 trillion of assets in the trust industry, of which 1.1 trillion is exposed to real estate. My estimate was 1.3 trillion of assets exposed to real estate. So we're capturing most of the exposure there. Just to give a bit of background towards the trust industry, which you can also think of as the shadow banking industry. This industry is outside of the formal control of the banking sector. These companies will give funds to those who find it difficult to raise funds from the conventional banking sector. The customers are typically higher risk, which is the reason why they find it hard to go to the conventional banking sector. You may remember back in 2015-16, a lot of people were getting worried about the exposures to the shadow banking sector, and that is where the government came in and cleaned the sector, essentially introducing more rules to limit the amount of debt and increase the oversight over the trusts. And you can see, therefore, as a result of more supervision by the government, that the size of the trust industry has fallen from its peak of more than 25 trillion in 2017 to 21 trillion today. On the right-hand side, you can see the exposures of the trust industry. You can see it only has 7% exposure to the real estate sector. If we go through the same sorts of sensitivities for the trust sector, where again, we look at potential losses on the top, implied NPL ratios in the middle, and then the losses as a percentage of the capital and equity for the trust sector. If we just go down to the bottom table, you can see that in an aggressive scenario, where if you thought there was a 50% probability of default, and in this case, 80% of the assets were lost, you can see that the losses are more substantial here. So 61% of the capital in the trust sector would be wiped out. So unlike in the banking sector, where because of the rising capital adequacy ratios, we think that the system can absorb losses, we do think that on the other hand, for the trust sector, that capital injections may be required because of the losses there. So there will probably be volatility in this sector, but we think in the grand scheme of things, the impact on the wider financial system likely to be manageable in the grand scheme of things because of the lack of linkages to the wider banking sector. And then for the bonds, which account for 14% of developer debt, again, you look at the split between the state-owned enterprises and the private property developers. State-owned enterprises account for 61% of the onshore property bonds, and less than 1% of these state companies have defaulted. The remaining 39% of the bonds is held by the private sector, where more than half have defaulted. The losses here will ultimately be borne by the holders of the bonds. In the offshore market, it is worth noting that back in 2020, the non-defaulted offshore bonds totaled $160 billion. And now, because a lot of the bonds have defaulted, there's only now 53 billion which have not defaulted. The point of this is that a lot of the pain has already been felt. About 30% of the offshore market now has not defaulted. A few more may fail, but we argue that most of the pain has been felt. In this offshore bond market, most of the bond holders are foreign investors who will bear the losses. The impact on your typical Chinese investors is limited because this is the offshore market we are talking about. So losses will be felt for bondholders, but the impact on the broader financial system is limited in this case. So those were the problems. What about the solutions? So the debt, which I've been talking about, only makes up 20% of the capital base of the property developers. The pre-sale deposits accounts for 22%, and the accounts payable is another 27%. So the pre-sale deposits would be the Evergrande model, essentially, where they would sell property now. The customers would give them the funds today, or a portion of the funds today, even though construction has not started. And then Evergrande would use those received funds to fund the next property project. That model was stopped by the 3 red lines policy, but does still account for 22% of total debt. And the accounts payable is the property developers' customers essentially granting credit to the property developers. So these two figures are quite important because of their wider linkages to the financial system. So the accounts payable is important because if the suppliers are not being paid back on time, then they are not receiving the cash. They cannot pay their staff, and then that leads to an impact on the incomes of these workers, and that's a direct link to the wider economy. So the government, as they have been doing, they've recognized it's very important to complete the projects to reduce the impacts on the wider economy. And I would say that part of the problem is now okay. And I say that because some of you may remember last year that certain projects were stalled. A large portion of those projects have resumed construction. That was looking at the liability side, but now we've got to look at the inventories, and that is on the asset side. So inventories account for about 60% of the property developers' balance sheets. And then if you delve deeper into the inventory, you can see that only 10% of the inventory is complete, 65% is the work in progress. And it is critical that these projects are completed, again, because of their impact on the wider economy. But then what do you do with some of the inventory that is sitting there on the distressed developers like Evergrande and Country Garden and so on? So again, based on what Goldman Sachs say, they estimate that stressed developers have 27 trillion of inventory on their balance sheets. They think that the liquidation value is about 15 to 20 trillion, implying a write-off of 26% to 44%. So it's hard to pick a number, but let's go with their estimates. What do you do? How are you going to deal with 15 to 20 trillions of inventory to acquire? You've got different solutions, none of which by themselves is big enough to be the only solution. So the state-owned developers could be asked to help, but they only have total assets of 8.7 trillion. So you've got to acquire 15 to 20 trillion, but the state-owned developers only have total assets of 8.7. So they are not large enough to be the only solution. They're probably unwilling to acquire poor quality assets, but I think if the price was low enough, they could be enticed to do so. There has been talk of local governments coming in, but I think they are facing funding pressure of their own. Local governments derive most of their revenue from land sales, and if land sales are down more than 30%, the local government's revenue is also down significantly. So they are facing tight funding constraints themselves, so I don't think they can be called in to help. I do think, as a brief side point, that eventually the funding model will be changed. Currently, China does not have a property tax. I think probably when the current cycle of property is over and some of these problems are resolved, that a property tax will be introduced so that local government's funding model is essentially fixed. The third solution is the asset management companies. They can be called in to help, as they have done in previous property downturns, but they already have 40 to 45% exposure to real estate. Additionally, their total assets are only 4.5 trillion. So if you need to acquire 15 to 20 trillion, and they've only got total assets of 4.5, they are also too small. So they could be called on to help, but probably do not have the scale to help that much. So I think going forward, what we need from central government is a comprehensive plan on how they are going to deal with the inventory problem. I personally think the government is being too reactive. They're only reacting to problems as they come. I think they need to be more proactive. So give a plan before the problems arise. I think it will be very important to know how the losses on the various components of debt will be recognized. So that is the bank debt, the trusts, and the bonds. Which financial groups will need capital injections? So that is those smaller banks. That will be some of the larger trust products. How will that work out? And then what is the plan with the inventories of the unsold property? I do think because of China's financial system, it is unlikely there will be a sudden debt crisis. As we've been through, most of the debt in the property sector is owed to the banks. The banks are all state-owned. It is domestic money. It is not foreign money. What China can do is extend the maturity of their loans for as long as is needed. So the banks can say, we'll give the property developers another 10 years, another 15 years to work through their debts. And at the end of 10 years, they would recover as much of the loans as they can. This is a playbook they have used in the past. And this is what makes China's financial system very different to the Western system. And I think that's something that a lot of people get wrong when considering China. They use the same toolkits they use and learnt about in Western universities to apply to the Chinese, and it just simply does not work that way. So the Chinese can extend the maturity of their loans to give themselves time to work through this property cycle, which is in a very particular sense a good thing. But that, of course, has drawbacks. It essentially can lead to a situation where the Chinese are lending too much and for too long to companies which are essentially bankrupt and which should not be allowed to run for a number of years. You could make an equivalence to the Japan situation. So the zombie firms which are insolvent but keep on getting funds lent. I think this is an interesting question, and I think it is a risk that the banks lend to these zombie companies, because what it essentially means is too much credit is flowing to companies that really shouldn't be deserving of these funds, and therefore not enough credit to be lent to the interesting economies or parts of the economy such as electric vehicles, semiconductors, and so on. So I think that is a real risk that needs to be acknowledged. So China's financial system is helpful in the sense that they've got the time to work through these problems, but the drawback of that is if they do not do this right, they essentially lend too much credit to companies which shouldn't really be deserving of it. So all depends on what the plan from the government is, and this is something to keep an eye out for over the coming months. So that was really a run through of the high level numbers for the property sector, putting some numbers to some of these claims to understand where the stresses are likely to lie and where they are not likely to arise. But I think it's also important to go through the bright spots to the economy. And this is really what is underpinning China's move up the value chain, their plan to avoid the middle income trap. So I just want to go through some examples quickly of where the Chinese are doing very well, despite all of the negative press. Here showing the Chinese market share in various parts of the EV supply chain. Really in material processing, making the batteries and the cells and making the cars themselves, the Chinese are very competitive in many parts of the EV supply chain. I think the Chinese are very competent in all parts of this, whether it's resource extraction, material processing, and so on. We see that in our investment portfolios where we own companies that make battery production equipment, make the electrolytes, and so on for these cells. The quality of the cars now is very good. So I was in China at the end of May, where I was in a lot of BYD taxis, and I think now the quality of their cars is actually very respectable. If you took off the label of the car, you wouldn't think you're in a Chinese brand. The quality has really taken on a lot of improvements. And now I think what we're seeing is the Chinese expanding into more foreign markets. Really the only foreign competitor who can compete is Tesla. I think the European car manufacturers are well behind in the EV chain. And I think this is a very good example of what is going to drive China's move up the value chain, what is going to move China from GDP per capita of $12,000 today to $20,000 and then $30,000 in the medium to long term. In renewable energy, the Chinese are also very competitive, whether that is making the wafers, the solar modules themselves, the solar glass. The Chinese have significant market share, and it's a similar story in the wind space. In semiconductors, many people have now seen that Huawei are using 7nm chips, probably made by SMIC, that is China's most advanced foundry. If that is the case, which I think it is, China's made significant advances in chip manufacturing despite US export restrictions. I mean, I think it is shocking how much progress they made, and the Western press is completely downplaying the advances they're making. If you think about it, who can now make 7nm chips? It's companies in Taiwan, the United States, and now mainland China. And the question now is, can China make these chips at a profit, and can they make them at scale? And I think that is something we now have to see. But I think this is, again, the US export restrictions have probably actually worked against them, because the Chinese, across various aspects of the semiconductor supply chain, are making very quick progress. So I would like to thank everyone for your time. Hopefully that was a useful discussion of the debt in China. We do write a monthly commentary on the website as well, where you can see some more insights. So thank you everyone, and hope to see you in the webcast. Thank you. Bye-bye.